You're entering CNBC TV18's Fire Safe Studio, powered by Century Ply. Now with firewall technology.
Welcome back. Auto financiers and in fact auto and home financiers have been doing relatively well because there's been a pickup in the last quarter. Arulselvan D, the President and Chief Financial Officer at Chola Investment, joins us now to discuss what the outlook is for the way forward. Mr. Arulselvan, thanks a lot for joining in on the show. I want to start by asking you about what the growth could look like in disbursements in the vehicle space, because Q4 was quite strong for you. It was almost a 58% growth that you saw year on year. And things have picked up, especially in commercial vehicles as well as passenger vehicles, also rural-based tractors, etc. What kind of growth are you targeting for FY23?
FY23 disbursement growths will be somewhere in range of around 20 to 25%, going by what we are seeing in the market, and it will be clearly upwards of last year, because last year was actually a 9-month phenomenon. There's already a 12-month now. But from an AUM perspective, you may not see the same growth reflected, because the rundown of the moratorium accumulated assets will continue through the first half of this year. So you will see maybe in the range of around 15% growth on the AUM, but on the disbursement, they are confident of talking about 25%.
You're saying 20 to 25, sure. You're saying 20 to 25% growth in disbursements and a 15% growth in the AUMs, what you're targeting for FY23. Can you break that up for us between vehicles, MSME, home financing? Where are you seeing the strongest amount of traction now?
The vehicles is growing very well. Actually, April and May have seen a good growth, even compared to the pre-COVID levels. Actually, last year is no comparison, because last year has been a complete, because of the shutdown, there has been no disbursements at all. But even pre-COVID levels, auto as both passenger vehicles and commercial vehicles, both are seeing a good growth. Used is seeing a very good traction, because a lot of replacements are happening, and we see the used vehicle traction also picking up, especially in the 5 to 10-year-old vehicles segment. The lab business, which is the SME business, is also seeing very good growth. Actually, you will see that this quarter will be a good growth for the lab businesses also. Home loan will be of moderate growth, but it is again a growth as compared to previous years. So we see across the board growth happening in this quarter and in this financial year as such.
Yeah, all right, sir. But, the question on your margins then, because your liabilities, I understand, are mostly floating. So what's the outlook on NIMs in a rising interest rate scenario, keeping in mind that transmission could be done with a bit of a lag? So what's the outlook on this front? Go ahead.
Yeah, so if you look at our liability breakup, almost 60% is, bank borrowings. The balance 40 is on the market borrowings. So the 40% borrowings are from the market are fixed rate. The 60%, out of the 60%, 10% is fixed rate, and the balance 50 is on floating rate, both MCLR linked and market benchmark. The MCLR linked have got different reset rates, mostly annual, so they will tend to come up for repricing as and when the reset date comes into play. However, there will be an impact. We can't shy away from that impact. The impact of the price increase on the cost of funds is estimated to be in the range of around 50 to 60 basis points for the full year.
Okay.
However, we see that this could be offset by net credit loss reduction in the current year. So overall, we are still targeting to hold on to the levels of ROTA we sort of have been used to deliver.
No, so I didn't get the NIM number, sir. You were at around 8%, 8.1%. You put all the factors out that, so...
I'm giving you exact NIM numbers. I don't want to give any forward-looking numbers.
No, you think it could be...
For two reasons.
50...
we don't...
Yeah. So we want to get a sense it could be 50 basis points lower at worst, or 25 to 50 basis points lower. Is that the number you would like to go with?
Right. See, there are 2-3 factors that come into play, especially in a company like Chola, where the portfolio mix is very wide. So you have the heavies which are delivered at yield levels of 11%, 10 to 11%, and you have on the other end the used and the tractors coming in at around 20% limits. So it depends on the mix of the portfolio. Also, the NIM can be moderated, but then this has an impact on the OPEX and the NCL. So you will have, that's where we always try to track our performance more on the ROTA rather than on the NIM or OPEX or NCL, because the portfolio mix plays a big role in each of these line items. So what I'm trying to convey is, whatever be the mix and whatever be the impact of all the external parameters, we still will strive to deliver the 3.5% pre-tax quota levels which we are committed to.
Okay, got that. So there is a pressure from interest rates. What about expenses? Because I think in the last quarter that came in a little higher than what many were expecting, and that may have been because of perhaps underinvestment during the COVID period. There were also new businesses which required investment, the SME business, the consumer loans business. So could you talk a little bit about the expenses side, and also how are the new businesses doing?
The new business is doing really good, but they are of a very small base. So their growth by itself was not going to significantly impact the overall AUM or the profitability of the company in its in the broader sense. The expenses have been higher in Q4. You also got to factor in that in quarters where we do good on the results, our expenses will be high for 2-3 reasons. One, because our results are good because our disbursements are high or our collections are high. In both cases, the incentive levels are high. And at an overall level also, the variable incentives that we factor in for the employees are linked to profitability to a large extent, apart from other criteria. So that when the profitability is good, then you tend to have to provide a larger chunk of the incentives. So this is what normally happens. Of course, there have been spend on the tech side as well as on the new employment for people who have been employed for the new businesses. So those costs have also been high, and the new businesses are yet to deliver on the profitability because they still are on these are the first few months of their being into play. So as and when they start delivering profitability, then you will see the ROTA improving. But the new businesses are OPEX heavy, so they will be having an impact on the OPEX. But right now, as I said, the volumes are so small that they wouldn't make any significant impact.
So just a final question on asset quality. The gross NPAs for you have been on the higher side. I mean, even in the quarter gone by, the gross NPAs was almost 7%. Now, the reason I'm asking is because with the rising fuel prices, do you think asset quality could be at risk in the coming months?
You have to also take into consideration that the gross NPA number you are putting is relating to the new norms as per RBI, which we have sort of early adopted, while many others have not done it. So if the real NPA numbers or the stage 3 numbers, which is what if you are looking at comparatively with others, are much lower, it is in the range of around 4.7%. So first, I wanted to clarify that because we are not comparing apples to apples with regard to others. Second is, yes, the gross NPA numbers will come down. We don't see, the impact of fuel price increase impacting the earning potential of our customers. There have been fuel price increase, subsequently there has been drop, but freight rates have also increased. And so right now, the customers are able to service one EMI comfortably, but they are not yet good enough to service what they have sort of, could not service during the first quarter of last year when the COVID hit them. So to that extent, there is some amount of incremental gross NPA number or a stage 3 number that you are seeing continuing to, be in the book as of March 22. But this will be taken in the coming quarters. But as you would also know, Q1 and Q2 of any year, pre-COVID also, is always a dull quarters because these are quarters where monsoons are very high, so the employability of the vehicles, especially in mines and other areas, are low. So during these quarters, it will be more or less sort of held or will have a marginal reduction, but you will see considerable reduction in the festival quarters, which is Q3 and Q4.
Okay, all right. Sir, thanks so much for stopping by. We're taking all your views on board. You're confident about the disbursements, the AUM growth of close to around 15%, disbursements close to around 25%. The cost of funds could increase, which could put some kind of pressure on margins from here on. Well, the markets are moving very, very well. We have crossed that 15,000.